Hello, everybody. How's it going? I think the audio looks pretty good. I mean, video looks pretty good. The audio is probably fine. I have a little bit of I've had a cough for a few weeks, so pardon my my voice. I'm just getting over this thing. Our whole family got it. So why am I doing YouTube? It's been about a month since my last one, and I wanted to write up a long post on AlterX for Value Investors Club, but I don't like writing. So I decided I would do this, and I would post this link for nobody to watch on Value Investors Club. Now, for those of you that follow me on Twitter, you've heard most of this before, so there's nothing new in here. I'm just kind of blown away by what I think is, if you control for multiples and for the macro, which you can always do by shorting companies that are comparable to AlterX, I see a very easy and clear path for this to go up 50% in the next 2 to 3 months without a takeout. And I'm going to highlight why I feel that way on this video. So what's happened in the last month with AlterX since they posted earnings and I did a YouTube on it? Not a great deal has happened, except the 10-year has moved dramatically, and currencies have also moved, not as dramatic as they did maybe a week ago, but they went from being a headwind for AlterX to a tailwind for AlterX, which will affect their reported ARR when they report Q4. It should provide a multi-million-dollar tailwind, versus the previous headwind. Regarding the 10-year move, I still think there's not a great chance of a takeout here for a few different reasons. The main reason being, if the founder wants to still own this and doesn't plan on taking any money off the table, then he would rather own it as a public vehicle, because they have 2026 and 2028 debt that's much cheaper than it would be if they had to refinance it for an LBO. And he doesn't gain anything in an LBO unless he takes some money off the table or he buys more and he owns more of the company. Given where the debt markets are today, I don't think they would be able to do any kind of real leverage on here. It would be just refinancing the existing debt, which would mean he would just own the same percentage of the company as he does now. And it doesn't benefit him to do that. So I do view the odds of a takeout low, but not zero. And I also think that there is, though this hasn't really happened too much in software the last few years, there is a non-zero chance that somebody strategic could buy them, given how cheap it is and the stickiness of their ARR and the massive synergies they could have rolling this into an existing sales force. But this video is not going to be focused on a takeout. It's just going to be focused on what I think is going to happen over the next 3 to 6 months, really the next 3 months, and why I'm so confident in this working. Again, controlled for macro and the overall stock market. If the market's down 10 or 20%, then obviously multiples are going to come in. But I do think we have a very large margin of safety given where this is trading. So let's take a step back. Okay. So first I'm going to send a link to a really good Substack that I found that does weekly write-ups, or I don't even know why I'm having trouble speaking English right now. Weekly, I don't know, comp updates on SaaS, and they go into pretty big detail about the entire SaaS software comp set, and where the multiples have been and where they are, and they break it down based on a bunch of different factors. But the thing that's most interesting to me in this link I just sent is if you scroll down towards the middle and you look at when they do there's no pages on here, but they do bucketed by growth, and they do what the next 12-month revenue multiples to enterprise value is of low, mid, and high growth. And the way they define low, mid, and high growth, high is greater than 30%, mid is 15 to 30%, and low is less than 15%. Now, the time I've spent on SaaS over the last year, it's very clear that only a very specific kind of investor likes to invest in SaaS, and it is not value guys. It's growth people. And if a company is decelerating its top line and on that path to single-digit top line growth, obviously the revenue multiple gets just annihilated. Conversely, if a company is showing acceleration on the top line and is in that 15+% top line growth range, it's awarded a very high multiple on revenue. What happened with Alteryx, and this is why I think this is such an interesting situation, is that this was a company that was growing at 25+% every year through last year, through 2022. And they still were growing above 20% in the first quarter of this year, okay? I'm looking at both revenue and also ARR, but ARR is the most important metric, so it normalizes for lumpiness of contracts. When Alteryx missed in Q2, they decided to take a sledgehammer to expectations and took the company from a 25% grower to a 12% grower, okay? And as a result, of course, the stock went from 38 to 30 after it blew up, which is the fire under the market. I'll take it. As a result, the stock was already fell from 70 to 70 to 50 before they reported Q1. And Q1, they missed ARR, and it went from 50 to 38. So it was a huge decline from 70 to 30, all based on the concept that this company was turning into a low or no grower and that they had competitive threats from AI, okay? My argument all along has been that the net retention rate of the company has been very stable, right? It came in at 119 last quarter, down from 120, and similar to the 119 it was a couple years ago. The high it's ever been is 121, okay? In that net retention rate, you have it's trailing 4 quarters. You have 3 quarters that have been below what the street had forecast going into this year, right? You had a weaker quarter 1, you had a blow up quarter 2, and then they just reported quarter 3, which was better than expectations, but still much below where they would have thought it would have been a year ago, okay? So the only quarter left in that trailing 12-month net retention rate number is quarter 4 of last year, which was very good, okay? Based on the guidance that they have given for quarter 4, which, by the way, was not raised after they blew out quarter 3, it basically models a 111% net retention rate for quarter 4, down from the 119 trailing. And I think the estimate was 117 that actually happens in quarter 3. I think the street is getting this so wrong, okay? And I'm going to walk through why I feel that way. So the first thing that's important to note is that over the last 2 years, they've changed the way they sell contracts. And over half, or about half, I shouldn't say over half, it's about half now of the contracts that sell are these things called ELAs, which basically it's a pretty novel, smart idea. Let's say you have 1,000 seats you want to use Alteryx for. In the past, you bought 1,000 seats and that's all you can use, right? Maybe they let you have a trial or something for a few months for other seats, but for the most part, you buy the seats you're going to use. What they did with these ELAs is that for the 12 months after you purchase your 1,000 seats, you get 500 more seats, 50% more for free, and you can use them anywhere you want in your organization. And then after the 12 months is up, you have to then pay for those seats if you want them. And then if you do, you now have 1,500 seats. And guess what? You get another 750 seats that you can test out for the next 12 months. The idea here is to get a frictionless, no-cost way to get Alteryx embedded in an organization. And it works. And they have data that shows that over the last 12 or 24 months, they've seen the burst activity in real time, which gives them good visibility into what renewals are going to look like for Q4. Okay. But there's more than that. So when Alteryx missed in Q2, they cited 10 contracts that were not part of renewals that they weren't able to upsell. And they said recently on a either on the last conference call or at a conference that they've since closed 5 of those 10 deals, but smaller than they expected. Okay. It's my belief that the weakness they had in Q1, Q2, and Q3, a lot of that will catch up with Q4. So they will recapture the renewals that they didn't get off cycle when the renewal happens in Q4. So they actually have a tailwind in Q4, more so than they would have going into this year, given how weak Q2 and Q3 were. But don't take my word for it. Let's just look at the last 3 years and what kind of patterns we see with Q3 and Q4 ARR dollar growth. So I'm just looking at Q3 over Q2 and Q4 over Q3, and how many, not percentage-wise, just actual gross dollars they've added in ARR. So in 2020, I'm going to post it here, and then I'll talk about it. And anyone that's been on Twitter, who's most people probably follow me on here right now, have heard me talk about this, but oop, that's not right. Hold on one sec. Did this work? This works. Okay. So in 2021, in Q3, they added $31 million in ARR over Q2, okay? And in Q4, they added $59 million in ARR. It was a much bigger quarter, right? Almost double, okay? In 2022, they did 30 million of ARR. In Q4, they did 76 million of ARR, more than double. Note that 2022 ARR in Q3 was down on a dollar basis than 2021. And as a percentage, it was down even more because, of course, it was a much higher base in 2022 than 2021. Okay. Yet the Q4 number came in significantly above the Q4 of 2021. Again, these are just dollars, not percentages. Clearly, every year it's a higher base. So you should expect you get more dollar ARR than you did the previous year. Now let's look at 2023. They did 24 million, and that included a currency headwind. Okay. The street is estimating they do 31 million in Q4. Okay. As we've seen in the last 2 years, they usually double what they did in Q3. And this year is even more pronounced Q4 renewals than any previous year in the company's history. It's all being weighted towards Q4, more so than it did in 2022 and 2021. Further, your net retention rate is almost essentially the same as it was in 2022 and 2021. It was either 120 or 121 or 119 all those years. And it's 119 right now. Okay. It's my belief that they are going to put up a monster Q4 ARR, as much as $70 million versus the 24 million that the street's expecting. Okay. But let's say they only do 50 million. Okay. 50 million in Q4. Well, okay. That would be double what the street's expecting. 24 million, which is just the guide, by the way. Or sorry, 31 million is the guide. Let's say they do 50, which would be a significant beat. Okay. The reason why the setup is so great is that for 2024, okay, they are guiding. The street is just taking the company at its word that this is now a 12% grower. And the company has set up this mentality that they are going to sandbag guidance going forward so that they can beat quarter after quarter after quarter, which is what they used to do before they got into this this jam this year when the street was expecting 25+% ARR, right? What the company has essentially effectively done is they've taken expectations for this to be a 25 to 30% grower to now people think this is a 12 to 15% grower, really a 10 to 15% grower. And it's my belief that this is much more likely a 20% grower. And the 12% that they guide to for 2024 is going to be significantly above what the street's at because of the 20 to 30 to $40 million beat that's going to happen this year. So all street numbers are going to have to go up significantly for 2024, even though they might still keep the top line growth at 12%. And that will then set up huge beats each of the quarters of next year to where they ultimately do high teens to 20% growth. Now, what is a company that has incredible stickiness, that this user base is described as cult-like? What is that worth from a revenue multiple if they can do that high teens, 20% growth? Well, if we pull up that link I sent you on Cloud Judgment on the Substack, you can see again, this is blending dozens and dozens of companies. Some of these are security software companies that have higher multiple. Some of these are, crappier, less sticky software as a service companies that have a lower multiple. It's a blend, okay? We see here that the mid-growth median, that's for 15 to 30% growers, is 8.7 times sales, EV to sales, okay? The low growth median is 4 times, okay? This, if they did that high teens, 20% growth next year, and I think 20% is probably on the low end. I think they could do low 20s, depending on how quarter four shapes up and how kind of traction they get. But let's just say it's high teens, 20%. What kind of multiple should be put on that kind of grower? Again, $1 billion, this is not a small cap company, really. It's $1 billion business that can easily be put into a larger software company, cutting out hundreds of millions of dollars of costs, both SG&A and sales and marketing. I think you can get to a 6 times multiple really easily. And that would not be expensive. Again, this is public comps, somewhere between 4 and 9 times. Okay. I'm using 6. If we use that 6 multiple, where does Alteryx trade? Well, there's about 80 million shares outstanding if you don't account the PSUs that only vest if it's above $90 a share. There's no reason to count that because it's not going to be above $90 a share in any of this analysis. If it is, great. We'll make a lot of money. I'm using 500 million of net debt, which is very conservative because they should pay down at least 100 to 150 million dollars of debt between now, or it should be net, not paid down, but there should be 150 million dollars less net debt this time, or the end of next year, given the significant free cash flow they're going to generate. I'm not taking that off. That's $2 a share. Okay, I'm just using the 500 million net debt. That's today. Okay. Right now, Alteryx is trading at 3.28 times sales for 2024. Yes, it's trading below the median low grower of the comps. At 4 times, it's $51. At 5 times, it's $65. And at 6 times, it's $79. Okay. New Relic was just taken out at 5.75 times, and it's a slower grower than Alteryx. It's something like a low teens grower, just taken out. Okay. Coupa was taken out at like 9 times, and it was like a 15% grower. Okay. I believe once the street sees an acceleration of revenue growth, this is going to go up 30% overnight. Now, I don't know if we'll see that in Q4 but I feel really confident that we'll see a big beat, which is what this company's always done. They've sandbagged for years until they got above their skis, and they just weren't. Look, they're not a 30% grower anymore, and they're probably not a 25% grower anymore. So they came into the year with that guide, and they couldn't hit it. They're having a hard time getting new customers in the door. They're already in half of the global 2000, and they have very low penetration in that half they're in. So they can expand rapidly for years to come just with their existing customer base. They don't need net new customers. The 119% net retention rate, if it holds, would mean that they would grow by 19% a year just from existing customers. That, to me, I think, is the path. The path is that you see that it's clear that this is not a shrinking business. They'll show stability in the net retention rate next quarter. And sell-side will have to upgrade it because they'll see that this is a high double-digit grower, or a high teens grower that's inflecting on cash flow, right? They're going to grow margins next year by 400 to 500 basis points, okay? Let's talk about bottom line. You don't want to talk about sales? That's fine. I believe that they'll beat this quarter by 20 or 30 cents. Again, they do this every quarter. They sandbag every guidance and they beat by 20 to 30 cents. So that's really not that profound of a statement. And they will put up this year something like $1.15 to $1.20 in earnings. The street's at 92 cents. The street has next year at $1.17. The street has it at the same level that they're going to put in this year, despite they took out all these costs this year, and they're going to grow top line next year by, call it 15 to 20%. And there'll be multiple 100 basis points of margin expansion. Next year's earnings should be something like $1.75 versus $1.17 the street's at, maybe even $2. This is just a $41 stock. It could be trading as low as 20 times next year's earnings, not including stock-based compensation, which of course you should include. But that's discounted for SaaS stocks that are growing. It just is, right? I'm a value guy. I understand that it's disgusting to talk like that, but it's just not relevant to the analysis to ask yourself where the stock's going to go. If you're going to adjust them all for stock-based comp, then it changes all the multiples across the whole field. And you could do that, but I could still do the same comp analysis, right? So pretty bullish. I'm pretty bullish on Alteryx. It's a gigantic position. I have a very hard time seeing where I'd get this wrong. If you read the transcripts from them and you hear their language, they are not backing away from the 119, 120% net retention rates. They have great visibility into their renewals, and they kind of make it clear that they're sandbagging the quarter. They guided to Q4 literally the exact number that the street was already at. Like 337 was exactly the number. So they didn't actually take any risk into coming up with what the real number should be. Oh, that's right. Also, next quarter, quarter one, the street's only at 10.7% revenue growth, which I think that will have to come up materially on the guide as well when they guide for 2024, because it's just going to be just way too low given what they're going to put up in Q4. So yeah, bullish, very, very bullish. Are there any questions about Alteryx? Let's see here. Yeah, Glenn, it's a great question. So I emailed a guy that has a sell on Alteryx. He has a $30 price target. The question is, I challenged some Wall Street analysts on AYX. Did they ever respond? There was two different sets of analysts I emailed. This is great. One of them has a $40 price target on Alteryx and a 4x sales multiple. And I emailed them saying that their math is wrong. If you use 80 million shares and 500 million in net debt, 4x gets you to At the time, I said it was 47.50 based on what their revenue number is. And they had 40. And I said, you should update your numbers because you have factually wrong math, right? I emailed them twice. They ignored my email, which is really something, right? I mean, I'm literally just saying their share count's wrong and their net debt's wrong. I'm not even questioning what their revenue multiple should be or what their revenue estimate is. Ignored me. The other guy has a $30 price target on Alteryx and a sell. And I got into a very interesting email with him. He basically told me he thinks the product's amazing. He thinks it's a cult-like sticky business. And he doesn't know why they have guided to what they're guiding to unless the business is going to fall off a cliff in Q4 to the 111% net retention rate. He has absolutely no reason to have a sell on the stock. He says he's gotten it wrong in the past on both sides, the buy and when he's had buys on it, when he's had sells on it. He said that he has lots of time to upgrade based on what the trends happen over December and January. He doesn't see a catalyst to get it to revalue in the near term. It was the best conversation because I was hoping he would tell me, you know, we think it's being taken over by AI or there's some competitive threats here, or it was none of that. It was basically management fucked up, you know, Q2, and he's too stubborn to upgrade it. He didn't say that, but that's what he was basically implying. It's crazy. So, you know, all these guys are going to be left behind. They're going to have to upgrade it because it's not going anywhere. Brokers we speak to tell us consensus seems to be that the bid is dead. IEP scared that AI GPT APIs will be as good as AYX data management systems for nothing and used to get a lower bid that AYX won't like. So George, I don't think it matters if the, first of all, I think that's nonsense. It's in the numbers. The numbers are not showing that this is being displaced by AI. Okay. If it was being displaced by AI, the founder would want to cash out and he would have taken any bid that he could have taken and sold. He forgot about rolling it. He would get out. He knows the business better than anybody. And finally, Insight Partners, which only has a $50 million position, Reuters reported that they wanted to acquire it. Why would they want to put money into something that they know the most about and they want to turn a $50 million position into a $4 billion position? No, what happened was they weren't able to buy it for $42 a share, right? The stock was 30. They probably bid 40, 45. And the board says, we can't take this. We can't sell this at 4 times or 3.5 times sales when it's worth, 6 times sales. So I don't own this for PE. I didn't own this for PE when I started buying this. And I did YouTubes on this for the whole last 6 months. But I do not think that the bids are dead. I think PE would love to own this. I think that it's the exact business they would like. It's misunderstood in the public markets. Everybody thinks it's going away when the net retention rate numbers tell you something completely different. It's at high 80s gross margins, and you can do things with it privately out of the public markets that, quite frankly, the public markets just aren't giving you credit for. So, it's not my concern that I don't think it needs to get taken private, but the math still works. You can take it out at 55 or 60 bucks today and you're stealing it. At 60 bucks right now, you'd be paying 4.75 times sales versus New Relic was 5.8 times. And you'd be stealing it. And you could easily merge it with another, Bravo could put this with their other analytics company and cut out hundreds of millions of dollars of costs. So, but you can't own something for a takeout. All right, Shamu, I'll try to find you. No guarantees, but I'll try to find you. It's hard for me to find people on here. All right, well, that's Alteryx. I just have a very hard time seeing where we'd be getting this wrong. Okay, Q3 showed that the business is still growing rapidly. The net retention rate was held in there. And, I just don't get it. It's just taking time. That's all. It's grinding. It's grinding back up to, 5 times sales. And that's what's going to happen. So Let's talk BridgeBio a little bit. Still love the stock. You see these deals happening for $5, $7, $10 billion the last couple of weeks. And I think BridgeBio is superior to all these companies that are getting taken out. I think that their lead franchise that they just filed the NDA for is a multi-billion-dollar drug. It's, it'll be the best in the market. And you take that with the other three compounds they have in phase 3, that could all be multiple hundred millions to, $1 billion in sales each, with no need for new capital. I think it's probably one of the most attractive takeouts in the market, if not, the most attractive. Whether or not they sell or not remains to be seen, but they have not partnered the drug yet. So it is still very much available for the pickings. And who knows, my base case is not that it gets sold, but it'll be in the 40s, in the next 6 months, I would guess. Obviously, there's a huge catalyst here with when ALNY's phase 3 reads out in April or May. I think that's all just a lot of noise. No matter what that readout is, I think there'll be a huge market for this drug, either in combination with the ALNY drug or just a standalone, because it'll be too expensive to have both of those treatments at the same time being given to people for very modest improvements, if there's even an improvement shown. So that's ALNY, that's a BBIO. QURE has a Huntington's readout in the next 2 weeks. People all expect it's going to fail. Again, it's not a pivotal trial or anything, so there's no p-value that's going to be read out. All you have to do is see really stabilization from 6 months ago, and you probably could have the stock go up a lot, just because it's trading at well below cash. So I don't have any belief that's going to happen, but I definitely like the setup going into it. So I'm excited to see when that Huntington's readout comes out. I have a big position in ROIV. That cash, once they close their deal they just announced, cash plus Immunovant is worth like $12 a share, something like that. It's trading at $9.85. You then get everything else ROIV has for free, which is billions and billions of value from an existing, they have an existing drug that's currently, already generating over $100 million of sales in the market, plus a pipeline, plus they have a multi-billion-dollar lawsuit against mRNA and Pfizer over the vaccines. It's nuts that it's trading with a negative EV right now. Doesn't make any sense to me. I blew out a Sphere. I don't own any Sphere anymore. The main problem with Sphere is that they have a huge cost overhead, and it remains to be seen if they're going to be able to sign in the near term artists that can fill the venue 100 to 125 nights a year at the same average selling prices that U2 is getting. Phish isn't going to cut it. Grateful Dead's not going to cut it. You need like a Beyonce, someone that can sell out 25 nights at high ASPs. And I don't know if it's going to happen so easily. I think it will happen years from now. I also think the movie was a mistake. They kind of went for a generic nature film to show the technology when they should have made something maybe with known IP or a story. And I think they learned their lesson with that. And the next movie will be much better, but that's a year away. Honestly, Dolan sucks, and I don't want to be involved with bad management right now. It's the same reason why I don't own Lionsgate anymore, and the same reason why I won't rebuy Ocular. So Ocular is interesting. It's gone from 250 to 380 on iPoint's pivotal readout or phase 2 readout. And, Ocular should go up on this, and it should go much higher because it shows proof of concept in a larger trial for TKI. It almost virtually, assures that Ocular's TKI is going to work, and it should be a superior TKI. In fact, if Ocular just had the cash it needed to run the phase 3 or announced a partnership, and there was no risk anymore of massive dilution, the stock would be multiples of where it's trading right now. It could be $10, $12 a share right now. So does Ocular work from here? I think it probably does work from here. I just have no interest in being involved in it. Look, there's 10,000 stocks out there. You don't have to own them all. I talked about this when I sold Ocular. It's one thing to be short a stock, nothing to be neutral on a stock. And I've just chosen to be neutral on it. So I do think it's going to go much higher. It'll be kind of frustrating when that happens, but you know, it is what it is. That was a very frustrating way that all played out. I think that's about everything. Any questions? Oh, I own a little AMLX. There's a readout coming this month in a European trial that has nothing to do with AMLX, but has the same kind of similar mechanism of action, and that could be a huge catalyst for it. And then obviously I'm waiting for the Q2 readout next year of their phase 2 trial. The thesis there is that it's gotten annihilated on a bad sales quarter. So I put it on after it blew up, and it's trading at like 1x sales or something ridiculously like that. 1.5 times sales. There's a decent chance the trial reads out positively, or positively enough to where it stays on the market. If it does, it'll have a huge moat in ALS for a long time, and it's worth a lot more. So that's not a big position though. Magnachip, one day we're going to wake up to Magnachip not missing and lowering, or we won't, right? Every quarter they bring down numbers for the quarter after it. They have no business in OLED. So OLED can only go up, or maybe it never goes up again. The power business is a real business, and it should continue to be a real business. The power business alone should be worth, call it $200 million, which is $5 a share. If you take the $5 a share for the power business and the $4 a share in cash they have on the balance sheet, that's $9 versus $6.75 today. That's not a lot of upside, but that values OLED at 0. So it's my belief sometime in the next year or two, if the stock remains this low, you'll probably get strategic interest again, because someone could pay $11 or $10 or $12 for it. Net of cash, they're buying this thing for a song versus what it was trading at when it was, acquired for $29. Easily the most frustrating stock I've ever owned, Magnachip. And it's a much smaller position than it once was, of course. But it's hard to have a narrative why you want to own it, given there's no near-term catalyst and there's no near-term reason for the OLED business to turn around. So I can see why people move on. AMS is a big cash position, which checks downside. I'm also long. Asymmetric situation is if Phoenix readout is good, let's go 5x. Well, if Phoenix is a total fail, then it's going to go down 50% or whatever or more, because it'll get pulled from the market. If Phoenix is just middles, it probably doesn't go down that much because it probably won't get pulled from the market. There won't be a lot of upside in sales, but I would think it stays in the market. Now, if Phoenix works, yes, it can go up like 5x. Exactly. I don't know LQDA at all. I think people talk about this. I don't think about it. I find SAVE totally fascinating, but I have no position in it. I have no idea what's going to happen there. My gut tells me that they win the trial. If they win the trial, does JetBlue try to recut it somehow? I don't know. I would definitely much rather bet on them winning the trial than losing the trial, but who knows? And I also wonder what this Hawaiian Airlines deal does to the whole situation. Apparently, Buttigieg has a right to block this. Even if the court greenlights it, the Department of Transportation can stop this from happening. But again, I'm not that close to this. So if that's a real risk, I don't know how that plays out. I'd rather have gigantic positions in software companies that I don't know what they do, that I think are going to go a lot higher. All right. I'm going to make some rotisserie chicken for lunch. Thanks for joining, and I'll see you guys next time there's something to talk about. Maybe after uniQure if it goes up 200%. Take care, and happy Hanukkah for all of you Jew-loving YouTube watchers. Bye, guys.